It should be a tax
Yes,
relief
who
in bracket.
is that? No, don't make any. I don't know.
No,
Who is that?
So that round would
That
it
could
be? So that will be what
okay,
you
someone
call.
is saying that. Yes, yes, they can say 30% straight line method. They agree. Trace causes part. Why did you play? Okay. Can you explain the how to get a CA again? All the two approaches. Okay. All right. So where would this 300 go? Yes.
So won't that be the tax amount for what do you call it, for the year 4?
Exactly. So it will be a tax liability, right?
Yeah. So meaning that at year 4 there will be no capital allowance.
Good. So therefore there will be no capital allowance because you're already owing us. Who by the account? You come OV. Yeah.
Okay.
So that is it. So that's how you analyze it, right?
So hello.
Yeah. So the one thing that I should explain the capital allowance, you find now, can you speak to my hearing?
I'm saying that if there's no capital allowance in year 4, does it mean that we are not going to calculate for tax relief, or the tax relief will be in bracket a negative liability?
If there is no what?
He said in that scenario there will be no capital allowance, and I'm asking
Yes.
if the tax relief will also be like a liability, a negative something that will be deducted from the cash flow.
See, can someone understand what you're saying?
Abi, in every capital allowance, you have to get a tax relief.
Yes, so yes, you are getting a tax relief.
So in the last year, which we are not having
Yes.
a capital allowance, but rather a profit, the GRA, are they going to charge a tax relief, but that tax relief will be a liability rather? I don't know whether you get to.
No, so you are making 1,000 series, right? So 1,000 is the profit. The profit, since you are making profit, the profit is not on any furniture, any capital expenditure, right? It's just a normal profit. So if you are making profit, we would just charge you a percentage on the profit. We just compute the percentage on your profit, and that will be the tax liability to you. I don't know if I don't understand your question. If someone understands, question can make it in or present it in a different dimension.
Oh, thank you. You've answered already. Thank you.
Okay, you're welcome. So the one who said that as you go over again, I don't know whether you are fine now. Maybe it's an old message. You're fine now.
Let's continue. 9 o'clock.
Looks like the person is not here. So let's continue. Let's quickly go and insert the capital allowance. So can you see the figures, please? Take short of the figures. Capital allowance. Can we go now?
In your corner. Yes.
Okay. So capital allowance.
I can screenshot that of it now. I think this money.
So what is the first capital allowance? What is the figure? So here we are deducting the capital allowance just to get the operating profit. We will come and add it back, right? So if you are using the capital allowance here, we have nothing like the tax savings and then the rest, right? Tax savings. But if you are using the tax savings, that one, then it means you're not coming to, you not also present the capital allowance. Take notes. If you are getting tax savings here, there will not be capital allowance. If you present capital allowance here, there will not be what tax savings. So because we are just deducting it to just get the tax liability or the operating, to get operating profits, then we compute the tax liability on. We will come and add it back to the figure. So what is the capital allowance?
2.55 million.
2.55 million.
2,550,000. 1,785,000.
1,785,000.
1,249,500.
1,249,500.
1,002,000, not 7,2.
If I say
Which one?
Yeah, a brussel.
Second Brazil. 249,500. What else?
915,500.
115,500. All right. So then, what will be our operating profit?
Tonight.
Operating
Hello,
profit.
sir.
Yeah. Hello.
Please, can you explain how you got the 2,550,000?
2,550,000. No, we just picked it from the capital allowance that we computed. Look at the capital allowance.
43,600.
The capital allowance item. So, can you see?
Yes, I can see.
Yeah, so we are just bringing them. I know that the last one we are using the 295. That is the total for year 4, right?
Okay.
Yes.
Okay.
So, sir, please, the scrap value affected that one.
Yeah, the scrap value affected that one.
It's go up, and the revenue is not showing, so we can't get the profit. 43,600.
43,600.
So 1 million.
1 million.
365,000.
365,000.
456.
456. Then the third year.
4,538,000. 446.
4,538,000.
446. 446.
4, 6.
46.
Anna,
And
is it like this?
yes, yes.
Okay. Then
Yeah, I'm also
this
having
one.
04046. The last three figures. I don't know. Let me check.
046.
Yeah. Let me. So someone should cross check to.
Yeah, it's 446.
Let me also cross check. To 453. 453, 446. Okay. So it's 446. Then what do we have? The last one is how much?
1,053,748.
700 and what?
1,053,748.
Completely, I get it. Please.
Is it confirmed?
Yes,
Yes, sir.
confirmed.
Yes.
Okay. So then what else? The tax rate,
So,
right? To compute the
yeah.
tax. How much is the tax?
Do you know?
30%.
25%.
30%? Hey, please take note to capital allowance rate is different from corporate tax rates. So tax is 25%. So 25% on each of them will be what?
$10,900.
10,900.
Good. Got
First
it.
one, 10,900. They are charging them tax. Second one,
341,000. 364.
3. Please, this one, I'm sure someone keeps short of it. The one that I was cleaning, so that you send it to me, so that because if someone I share it, it will not be part of the document. So that someone will be like, where did we do this working at? Someone should send it to me afterwards. There's a 3-4.
341 364.
364. What else?
The third one is 1,134,612. Yeah, good evening. Yeah. Please, how are you doing? 12.
Hello.
One,
Right, we can
good.
do it with this.
12. Currently, one, two.
612.
1,
Right.
2.
Yes.
Add a comic there. Yes.
Right, we can hear a conversation.
So have you seen the flyer?
263,000.
I've sent it to you, but with a different WhatsApp line.
Right, we can hear your conversation.
And since the
Are you
equal
there?
is active, so then you add it to it for them so that they will more recurrent, right?
263,000.
No slow down. Right,
Two-
so thank
I'm
you.
coming.
Yeah. And also,
Okay. If the tax rate on this one, is it confirmed?
Is it what?
Confirmed.
Yes. It's
The last
Okay.
year.
Then the last one is how much?
263,000.
Eh?
263,000.
437.
437.
Yeah. Thirteen 65 30 4.
All right, so that is
the first one is 22,700.
20 what?
32,000. 32,700. 32,700.
32,700.
1,024,000. Sorry. Yes, 1,024,000. 092.
1,024,000.
And 24,000. 1,024,092.
1024.
24.
I think should we add the capital allowance back before we sum them up? What do you think?
Yeah, I think so. Since the difference will not be useful.
Yeah. So let's just add back the capital. It helps us to just complete the equation. To add capital allowance. Let's add the capital allowance back. 2550. Then 1785. Then 1249. 500. Then maybe 915. 500. So give me the totals.
2,582,700.
582,700.
Yes.
Okay.
809,000.
809.
9,000. 092. Okay, to get us this.
092.
$4,000,000. 653,000. 334.
334.
Yes.
334.
Yes.
Yeah, 1,705,811.
705,000. 8.
811.
811.
I just. Maybe try.
All right, so this is our operating cash flows, right?
Yes.
Operating cash flow. And the investment, right? The next thing will be the investment. The investment.
8.5.
What is the investment cost? Investment cash flow or cost. That is how much?
8.5 million.
8.5 million.
Yes.
That's an outflow, right? Remember, this is our year zero. You get it?
Yep.
Hey, forgot about it.
It's Isaac here.
Oh yes, I'm here.
Okay. Hey, and why this Ade? Then, is there any other thing to that? Is there any other thing to deduct? What else? Well, yeah, we didn't get insurance, we didn't get selling, blah blah blah. What else? Scrap values. Scrap values are achieved from that. Working capital, no working capital.
Hello.
Okay, so that's it. Yeah.
Hello.
Yeah, hello.
You didn't add the tax relief to.
Oh, why didn't I do that?
Because you have to add.
I don't know. So which tax relief are you talking about? Which tax relief are you talking about? Hey, who is that? Who is that?
On Twitter, like they went over that. No, you don't know how
Who is that?
you documented. So now that actually are planning to finalize that.
When Aziz, Google.
Yes. Is there explaining something about
Aziz now Google.
Google now?
So
Big man.
which tax relief are you talking about?
I thought in capital investment, if they are allowing a capital allowance, then you have to calculate some tax relief on the capital allowance.
The tax shield or the tax
Yes.
savings.
Yes.
Oh, Bragwesi, did you just join us? Bragwesi, did you just join us?
Yes.
Okay. So I said that if you bring the tax savings, you would not even see capital allowance here. We would have, at the working side, that's what we would have computed. Look, the earning income would have computed, if you're using that format, means that we would have computed, who is that? Would have computed tax shield or the tax savings. Tax shield or tax savings. 30%.
No, don't say. The next time you be fine. It's not the kind of economy I just bit out for.
Who is that? So that one would not even bring the capital allowance on the face of the cash flows, right? So if you are using that format, I mean that will not bring this capital allowance. You would have to compute tax savings on each of them. So 30%, right? 30% on the written down value. It's 30% on the written down value, right?
Yes.
Yes. So when you compute, then those will come to the
you want to the currency and then of course
use that. That one you bring it just after you're done with the tax, and then you bring the tax sheet. So you see that the tax is an expense, right? Then the tax savings will become an inflow. So the one who asked the question, I'm sure I've answered you now.
So a question.
Okay.
With the tax savings, is the capital allowance times the tax rate, right?
It's the carbon the back we know we
Yeah, no, that accounting. Now, no, yeah, we.
So
I'm a sociology student and also an accounting student.
I didn't come let me go and start
Let's proceed.
Yeah, please, do you get my question?
Come again, please.
Yeah, I'm asking that for the calculation of the tax savings, it is the capital allowance or the depreciation times the tax rate, right?
Capital allowance. It is the what?
Times the tax rate.
Yes, and the tax rate. And the tax rate.
Yeah.
Yes, and the tax
I still
rate.
want to. Yeah. So
Hello.
meaning that what?
Hello.
So meaning that what? I'll come to you.
Okay.
Clarification on it. If you are following that, you will not bring the capital allowance and you treat that tax, you just calculate for the tax savings and treat it as an inflow, right?
Yes, and add it to the just as if you after computing the where is it? Just after computing the tax, not the tax savings about as an inflow, because it's a benefit, right? Yeah.
Okay.
And they want to,
okay.
but you want to really a much easier. We are now going to do an additional work to compute the tax savings for each of them and then add them and bring them. So this one that you just add, deduct, and then add it back. But professionally, we are not supposed to bring the capital allowance to the face, right? But examinally, you can bring it, right?
Yeah, please. Your line is breaking.
I say professionally, or in practice, we don't usually bring the capital allowance, but the tax savings, right? But examinally, you can bring it, right? I believe you understand when I say examinally.
Yes, please.
So any of the two, if you are comfortable with on tax savings, take it, comfortable with the capital.
Say your line is breaking.
Yeah, please, let's give him about 2 minutes. He'll join us soon. He has been logged out.
Okay. Yes, sir. Yes, sir. Wait.
There's no FM Nedim, pa. Mungo siya.
We organize it face to face. Now,
Tom textbook, FM textbook, 100 cedis.
Oh, Tawana.
I see we organize it face to face.
Face. Yeah, try. Yeah, shit.
Okay, so I've announced myself. I'm in now.
You left that affirmation. Am I on?
I left what?
So, on one crack.
Oh, I mean, my network no Vodafone, and so I just changed to MTN. Everywhere you go.
Telecell.
Bam. Oh, Telecell. Sorry. Telecell.
Don't worry, you'll buy data.
Telecell. I don't think it's the data. It is the network. All right. So let's continue. Where did you get to? I was explaining something, and then you couldn't hear me, and I was talking. Yes, where did I get to? Where did I get to?
Hello.
Yeah, hello.
Hello, please, about the tax saving. I don't get that, please.
Oh, okay. So the tax savings, that you would first of all compute your what? Your
The rest is like
your depreciation. So the depreciation is computed. Why am I getting feedback? One anyway near. Okay, so after you have gotten the written down value, the tax will be computed on that. Hey. Why am I getting feedback? Mute your microphone if you are not speaking. All right. Okay, good. So the tax savings is it's on the written down value, right? After you have deducted your depreciation or the capital allowance, then you compute the tax saving 30%, right? The 30% on the written down values. If that will confuse you, don't use the capital allowance, deduct and then add back, right?
Okay, thank you very much.
You're welcome. So please, can you quickly find the net cash flows? Can we find the net cash flows?
Yes.
Yeah, so the initial one would be 8,500. Then what are we getting for this? It will still be the same thing, right?
It will be the same thing, yes.
It will be 5,800. This one will also be the same. 2,809,092. This one will be what? 4,6,533.
Hello, sir. How are you competing for the net cash flow?
Okay. Okay then. Then this one will be what? 1,705,811.
Hello, sir.
Hello.
Hello, sir.
Yeah, hello.
Yeah, I'm asking how are you competing for the net cash flow?
How are we what?
Computing for the net cash flow.
So these are the net cash. It is the initial one is year zero. That is an outflow, and then we have the cash flow. This minus dash is the same amount. 2,809 minus dash is the same amount. So that is these are the net cash flows, and they will be the
okay.
Right. So now that we have the net cash flow, we can have our discounted cash flows.
a concern.
Okay.
Yeah, so with the scrap value, it's already no. I feel like we've not added it because we just found the difference, right?
Which one?
For the scrap value.
I thought we had already deducted it from the cost.
Yeah, I think we just use it to find the difference for the capital allowance. So I think that we were just finding the difference. So I think the scrap value must be added.
So,
Listen, you didn't continue with the recording.
hey, I sure the recording is not recorded. It's recorded. Yeah, so is that inventory? Okay. The expected machinery terminal value at the end of the year is what? 2 million. And planners was 2 million. That's the scrap value. I think we should bring it back. We should add the scrap value. Is it prudent we add the scrap value? I thought we had already deducted it from. We had already deducted it from. What's the name, girl? From the cost.
But
Yeah,
that was it does get the allowable in the balancing allowance.
I feel like it has already reduced. It has already reduced the cost, right? It has already reduced the cost as an inflow. The cost is an outflow, right?
Yeah.
So if the cost is an outflow and there is an inflow of 2 million, I think that inflow reduce the outflow by that amount before we enter the capital allowance. And beside the capital allowance, we are adding it back. It just helps us to compute the operating profit. We are adding the capital allowance back.
Yeah, I get it. Yeah. If we can continue.
Yeah. All right. So then how do we get a discount? So the discount will be what is the discount for year 0? It will still be the same amount, right?
Yes, 1.
It's an outflow. Discount for an outflow is still the same amount. So there's a rate. What is the rate? What is the rate? The rate for the nominal money rate. Nominal the money rate. Farmers Alliance uses a nominal money discount rate of what? 15% a year, right? So this is the discount rate. The discount rate I use to discount the net cash flows. We will discount the net cash flows into their present value, right? So 0.15. The number of years is 0. So you are getting what? The same amount. So in fact, if it's already in its present value, because that is year 0. Year 0 means what? It is in the present value. So the amount will be 85, right? 8,500,000. Then discount this one. So this one will be what? Year 1. Discount it on your calculators and give me the figures. Discount the rest It's year 1, year 2, year 3, year 4. Discount it and give me the figures.
$2,245,000.
And I'm sure it's an inflow, right? So yes, of course, 2,245,000. 2,245,000.
45,000.
245,000.
800.
826. So it's an inflow.
Point zero.
Yes.
That's more.
0.0. Other food I said I'm for decimals and 80. So everything must be without decimals.
Okay, sure.
No money doors, I'm going to work with decimals. We still time.
They even told us to the nearest 100. So
they said it in a question. Did they say it in a question?
Oh, not in this question.
So the next one is 2,000,000.
2,000,000.
2,124,077.
124,000
and 77.
Okay.
Hello.
Hi.
Please, I'm getting different figures.
Hey. For which one?
The discounted cash flows.
Yeah, this is boy.
The way the voice is done again. Please point you to where.
Please, I think it's the 8,500,000 divided by the 1 plus 0.15, and then raised to the power the number of years.
Oh
Yeah.
No, it changes.
No, it changes.
Yeah.
The number of this is for year 0. I only did for year 0. So year 2, the year 1, sorry, year 1 will be 2 million. What is year 1's net cash flow? That will be 2,582,700. That's right.
Thank
Then
you.
Hey, please, so I don't get it.
3 million.
You still don't get it. Who is that?
Right? Please write it.
You pick the respective net cash flows, right? And then you divide. So this is year 1, year 2. So you divide by 2 years. Year 3, 3 years. In that order, right?
3 million.
3
The
million.
third one,
And 9,000.
9,000.
3 million what?
Correct.
Tobo. 3 million what?
3,059,000.
And 59,000.
643.
643. Okay.
Yes.
And the fourth one is 975,000.
375,000. 3 what?
02.
0 what?
303. Run it to the whole number.
Okay. So these are the discounted ones, right? So Are we done? What is the question? We didn't even check the question. The requirement. What is the requirement?
First one is
The net present value.
The net present value. The net present value. So good. How do we get a net present value? What is the formula for the net present value? Your business.
We've done that, bro.
We've done that. We've done the net present value. Right. So I think that's all right. We are now going to answer.
No, that's not a net too.
Net
you add
present.
all the years and you subtract it from your.
Then you subtract your initial outflow.
Hey.
You add all the discounted cash flow and subtract.
You add all the years and subtract it from
And
your
then subtract from the initial year.
No, you add all the inflows. All the inflows minus the outflows.
present value.
Yeah, so
All the inflows,
all the present value.
all the discounted cash flow minus the investment.
Minus the initial.
More Montessori schools.
Yeah.
Rachel Montessori.
I see.
Christ the King.
I see.
So present value of initial, yes, minus the outflows.
Isaac, I feel the whole casa.
But this one is risky. You made a figure mistake, meaning that you can't even answer the questions right.
Exactly. So they are very deadly. So that's when you are doing it. In fact, it shouldn't even be your first question. Just go and do the run. It will waste your time. So just do the simple one, the theory questions. The one you done, and it can even be your last but one question, or maybe your last maybe an risk, maybe. So just be inputting the figures. Just enter them. Don't mark entries. You just enter them because you might make a mistake even with the computation on your calculator. Pressure down. So just input them. Yes, format. Just know your format. According to accounting, right? Just input and they will mark the entries. So now if you go and so the summation of all the inflows.
Bring Kambu no my figure name.
Bring it now. Go. Good.
Yes, so yeah.
President Neighbor.
And
So he solved one of the questions with you under this, yes. So maybe he can maintain that same question and change the figures or change some adjustment. He can introduce working capital in that question, or maybe you pick that this one is also in your book, but I think he changed some. He brought working capital or something like that, just a slight change. So you should know just the treatments. And then you can go. I'm sure this thing he will not get question from anywhere. It is actually essentially bring it from the book so that it will be like if you buy the book, then you pass.
8 million.
It doesn't know students. Sure.
8 million.
Hey, definitely.
8 million. 8 million what? 8 million.
404,000.
404,000.
849.
849.
Yeah, more
849.
Oh, man, come on to 0 into the moon back, 849.
9. I'm going to call Christ the King.
Oh, no.
8,404. 8,404,000.
Hey, and 40. Boss, we now would try. Why? Yeah.
Okonyang Panduria now.
8,404,000.
Senior born about Kumano,
851.
851.
499.
Oh, me tell you, schools now are different school, right? So the figures will definitely be different, right?
I any area to see.
Please,
Ridiculous.
I go with this figure. At least two people should confirm, right? So can I go with this?
Go with that. I've confirmed it.
Ayo. So then what will be the what? Outflow? Outflow is 8.5 million, right?
Yeah. Minus 8.
Then it will be a negative balance, right?
Yeah.
So the NPV will be what?
Negative
95,000.
Negative 95,000. 149.
149. All right. So let's go back to the question. What did he say? Net present value. Okay. So we are done with that. Discuss your findings. And I'm the one that will interpret it. So the next one is what?
IRR.
Internal rate of return.
The IRR from your business mass. What is the formula for the IRR?
Yeah, they are different.
So the new formula is
Yes.
Lowest discount rate plus.
So the new formula they gave to us.
Okay.
What are they writing? So the high rate plus.
They gave you a new formula.
Yeah, kind of same but new. So these are they presented it.
Hey,
so
okay.
the high
Let
rate.
me know. Let me know the new formula, please.
Yeah. So the high rate H plus. So the net present value of the low rate. So maybe NL or some net present value of the low rate divided by the net present value of the high rate minus the net present value of the low rate.
High rate
minus.
like this? Minus net present value
from this one
of the lower rate.
Yeah. Times all times. No. Don't even introduce any bracket. Just use the.
I shouldn't introduce any bracket.
Yeah, just multiply.
Multiply by.
Yeah, the high rate minus the low rate.
Hey, Kofi, I should introduce this.
Put it into the bracket. It's in the textbook as well.
Yeah, he's right. He's right.
Oh yeah, that's
this note we have.
I think we interchange.
Yes.
I think we interchange the high minus this one. Look at this.
It's still the same one.
Yeah, because we interchange this one. It's supposed to be NPVL minus NPVH.
NPVL.
Yes, but I think because here is high, so we have also interchanged it here. I don't know of this, but if it is in the textbook and
no, that's this not we have.
Is that
the textbook? The lower one is starting, not each.
Hey.
No, the lower one is what? Please check your textbook again.
IRR equals L plus L, the lower rate.
No.
And the slides to what is in it?
I'm talking about the textbook.
Please, let's use the one in the textbook.
But it's the same thing. The same thing. If you
let's go the one the professor said.
It's still the same one. The one in business math and this one, you still get the same one.
The business math, no, it is starting with the lowest. But but here we have changed the denominator for the so it can be the same here. You see, We on your sharp sir, the other mark and they give it to someone and say, hey, what is this formula? Me, what I can see is oh. So don't make provisions for someone to mark you down. Maybe no. Okay, maybe the answer and the same thing now. But
so you write the two formulas. You write the two so that will compare.
Okay. Right. So you go and try this one. But me, what I know is this. So I've not tested this one to know whether I'm getting the same answer. So when you go and you go and test it, okay?
Yes. Winning you. Fantastic. Sharp.
I'm in the shape brackets, no? Okay. So
yeah, that's the one in the slide.
Okay. Or test it and see if I would. Okay, I just go and test it so you can test it and give me the feedback. Right. So now, why are we getting a negative figure? We are getting a negative net present value because this means that we used a higher rate. The higher rate is giving us this net present value, negative. It means that we need to choose a lower rate that can give us a positive figure. Because if we are getting negative for NPV, it means the rate that we use is too high. If it's too high, then let's choose a lower rate. So, so now the NPV and the higher rate gave us how much? NPV, the higher rate gave us how much?
95,149.
So that is negative 95,149, right? Yes. And then the higher, what was the higher rate? The higher rate is 15%.
15%. Right?
Yeah. Then NPV lower rate. NPV, you don't know, right? So that is what we are about to find. And so, what would be the lower rate? Which rate do you think we should?
10%.
10%. Yeah. Okay. So 10%. So let's do our analysis, right? So under the same, let's bring our net cash flows. Net cash flows. The net cash flows, first one here saying 8.5. Second one here.
2,582,700.
2,200,000
245.
Yeah, mention the figures for mention. I want to go.
2,245,000.
25.
So are we using the net cash flow?
Yeah, net cash flows, not a discount.
2,582,700.
Oh, you know the sheet up. Where you know the sheet up?
Yeah, next to it.
I mentioned who got to like who the tenant is the better also we need to our tenant better. So 258
2700
2700
280 9092
9092. Okay.
465
465
33
33
34
34. Is that one? Last one.
170
170
58
okay
5811
5811 5811. Okay. Then the discounted cash flow. You can say using 10% discount rate. So using 10% discount. So what will be the discount? The first one will still be the 8.5. So use the 10%, let's see. Give me the figures. Punch on the calculators. Give me the figures. Give me.
Hello.
Hi.
Please, what are we looking for?
We are doing the IRR. Look at the IRR. It's the formula, right?
Yes.
So the formula
Yes.
is L plus H plus NPV, blah, 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 blah. L means the lowest rate, and the H means the highest rate. So now, the NPV that we computed earlier is giving us a negative NPV. It means that the rate that we use in the computation is too high. We use 15%. So that is giving us a negative NPV. So what do you do if you want to find the IRR? Is that we should use a lower rate. Because if the higher rate is giving us this, then we need to get a lower rate that can give us a positive figure, right? That can give us what? A positive figure. So this is a try and error work. We just pick a random rate, a lower rate. Something lower than 15%. So 15%, if you choose 14%, you can even get a negative figure again, but a lower negative. Even the 10%, I think I'm not even convinced. Is it not too high too? Why don't we choose a single number? Because you might get a lower negative, which we are not interested in. We want to get a positive. So can we choose a lower a single number? Of 10 and 15, it's gap name one. But if we do and we get a positive figure, no problem.
5. Then let's take 8%. So that because 5. Yeah, 5%.
8 yeah, so the 8%. So use the 8% to compute and give me the discount cash flow. I believe you know the formula already. Present value is equal to future value over 1 Hey, one question.
For the first one, we are getting 2,391,389.
Le confirmant.
Has not
Le confirmant. Using rate of 8%. Someone should confirm 8%.
So year two, boss, year 2.
So I mean year one. Confirm year 1 for me.
No.
And run into the bomb.
2,391,000.
391,000.
389.
389. Yes.
Year 2, 2 million.
2 million.
408.
400 and what?
8,000.
408,000. Financial management.
For you, that's about 1 making sure it's
480 and 408.
2,400,000. 2408. 343.
343.
Yeah.
It will be 4, not 3. So it's 344.
Yeah,
344.
8.5 to 344. Yeah.
Okay.
Combine for which one? Combine for the money divided more.
Okay. Come Yeah, 2 customers.
Sini
Three 3 million, the third one.
3 million.
3,693,993.
Is it 693?
Yes, 693. 967.
967.
And the last one.
One, 2, 5.
Hey. Again,
$1 million. 253,000.
250 what? 3,000.
53,822.
Is it 50 or 60?
53, 53. 822.
822. 8 what?
22.
822. Alright, so guys, give me the NPV.
Give me the MPV. Because give me the MPV. Give me the MPV. Guys, be fast. Give me the MPV.
Sum all of this and deduct from the NPV is present value of the inflows, value of inflows minus present value of outflows. So what do you have? We share the visual. Hey, I'm going to go to residence back.
Minya 1,247,522.
For which one?
For the MPV, the lower. No, the MPV, like I sum the inflows and then I deducted the outflow from it. So that's the MPV.
So the MPV is basically what?
So 1,247,000.
247,000.
522.
522.
Yeah, Obi to me confirm.
Confirm.
A question.
Okay. Someone.
The present value of inflows. Please, how did you get that amount? The total amount before you.
What's your? You can.
Yeah, please, the present value of inflows.
How do you get it? And also the present value of outflows. How do you get that one?
Oh, it's the summation of all the inflows. Inflow near positive. 1, 2, 3, 4. They are positive figure. They are inflows. Outflow near negative.
Okay.
So it's a bracket.
Okay.
It's just one. This one. So you add all of this and deduct this one from that, right?
So which one? Like I can't see the one I'm talking about.
Look. Can you see this? Look at my pointer.
You
Can you see this? Can you see this?
Pointer be out.
You can't see the pointer.
Yes, please.
Hey, machine when I use
Who's there?
I can't see my pointer.
Me too.
You do
We can't see it.
Yeah, we can't see.
I don't use plenty of 2 and now.
Yeah.
And you can't see my pointer. Then see also.
Oh, yes. The audio home.
Okay. You can look at the underlying figures. Can you see the underlying figures?
Yes, please. I can see.
So they are the inflows. If you add all of them, they are the inflows.
Okay.
And then the outflow is just the 8,500,000.
Okay, sure.
Sharp. Yeah, so that is it. So now, can we move to our IRR? Hey, question, I'll be 3 hours, 4 hours. Are you?
4 hours.
I can say explanation, no problem. Then, so how do we get the lower rate? What is the lower rate?
10%.
8%.
We use 8%, right? So 8% plus the NPV for the lower rate. 1
million.
All over the NPV for the lower rate again. Minus NPV for the higher rate. What did you get? NPV for the higher rate.
Negative
So minus
95,000.
Yes. So take note of this. Minus.
149.
95149. Right. So all of them times higher rate, which is 15% minus 8%. What are you getting? You can punch everything on the calculator straight up. So that is 8% plus 47 522 1247 5 minus
0.145.
Le conformant. $0.145.
Mm-hmm. 14.5%.
So that is 14.15%. Right.
Yeah.
So this rate, if someone use a different rate, it will not be exactly the same amount, right? It will not be exactly this. Slight difference is calculable, right? Slight difference. They should be within at least 14%, 14 point something like that, right? So if someone get 14.01, don't say that you are wrong, right? Don't say that you are wrong. I beg you. Okay. IRR. So this is the IRR. Okay. Is someone speaking? In background way. All right. So let's go to the question. IRR. So now just let's see the IRR question way. Okay. And then they've given us what?
Adi.
The target return on capital employed is 25% per year. So return on capital, every business has a target. This year the target is on the return on capital employed was 25%. So if this is our target, and we are getting this project is giving us something lower than the target. Is it a favorable one or it's an adverse one?
Adverse.
Favorable.
Huh? Adverse.
Right.
Adverse.
Is it an adverse or a favorable? If the return
Adverse.
is an adverse, right? Because we have targeted that at least we should get 25%. But this one is giving us 4.5. Our return on capital, the return on what? Capital, return and then profit. Return, you're going to say you are getting, right? Benefit. So if the return on capital is 25%, then we are getting 14.5%. We performing. No, we are not meeting the target, right? Good. So now, I think that is it for the internal discounted payback period. Discounted what? Payback period. So what is a discounted payback period? How do you get a discounted payback period? So we're just for that. That is I, Y. So the discounted payback period. What's the formula? A plus B plus what C. Do you remember that?
Yeah.
All right. So yeah.
Remember that. Oh.
That. And then cumulative. What's the difference between the discounted payback period and the payback period? Who can tell me? What's the difference between the discounted payback period and the payback period?
So
So
the discounted. Hey, who is talking? The bride.
oh, talk.
Okay, talk. All right, talk. Presidential and vice. The president has spoken, so let's hear from the vice. Again, you know the bride and they are going for position in the business. Guys, you know.
Yes.
Yes.
Yes, please.
Oh, okay. I thought maybe you didn't. And you know, I speak.
Okay. So for my knowledge in business math.
Please, I can't hear you.
My group, now fast. Now, just at all.
Which is the future is bright.
My knowledge in business math. I know that the discounted payback period, we use the net present value and the normal payback period is just the raw figures that you have. You just cumulative figures that you have. Discounted payback is the net present value figures after deducting it from the initial outlay. Yeah.
Ayo. Thank you. So the bright, let's any other person or the bright.
Okay, sir.
Yeah. Yeah,
So
let's
with the payback period. Okay. Okay, so from the slides, okay, directly from the slides, what I learned from is like for the payback period, that one they just do the deduction from the initial cash outflow, and that's for the discounted payback period. They do the deduction from the discounted cash flows. I know what I'm saying now. So the difference is that for the discounted payback period, they use the discounted cash flows, and that of the payback period they use the what should I say, the net cash flows.
Oh, okay. I see. So the key difference.
Sorry, the discounted payback period. It takes into consideration time value of money, and with the payback period, it does not take into consideration time value of money.
Oh, okay, very good. Okay. So the discounted actually is the time value of money, right? Since you are discounting it. All right. So all right, so let's continue. So year 0, year 1, year 2, year 3. So what are the discounted cash flow from year 1? Year 0 is 85. It's 5, right? So that will give us a cumulative of then what of year 1? What the discount cash flow for year 1?
22458.
2245826. 826. So what is the cumulative?
So the cumulative will be
It will be a negative balance, right? Because if it's more than this.
Negative 6 million.
Negative 6 million.
254,000.
17. Two what?
4,000.
254,000.
174.
174. Then the second one.
212,407.
212.
4072.
4072.
4077 or
Negative 4 million.
Where are you picking the figures from?
Abanwa.
Is it this one? Okay. So this is where you are picking the figures. So what then will be the cumulative?
Negative 4 million.
Negative 4 million.
132,000.
130,000.
102.
102. Yeah, 3.
Hello.
Hi.
Please, that one is 3. 7 no, it's not 70.
No, it's not 70. 977, right? 977, right?
So the cumulative T is wrong.
What is the cumulative? Yeah.
The cumulative, the last 3 digits is 097.
This digit.
The last 3 digits. The 102 is 097, right?
The
Hello there.
097.
Hello there.
Yeah.
Please, are we doing the normal one or we are doing the discounted payback?
We are doing a discounted payback.
Are we not to include the DFC like the factor?
Yeah, we have already worked on it. I mean, we have already. It is not the. You see, if we are having the normal cash flow, that's why we would have discounted it with the present value. Already, we have discounted it with the present value. So these are discounted cash flows. What's the actual?
Okay.
Yeah, I am going to Mandada.
Sir, please scroll down a bit. Yeah. Oh. Down. Please go back to the table. Not this. Where you calculated for the discounted cash flow. Okay. Thanks.
Okay. So the last one is what? Is this one 097?
Yes.
Okay, then 3. The third one is what?
305.
305.
9643.
9643.
Cumulated is negative 10.
Is it positive or negative? It's negative, right?
Yes.
So that's
10.
So we move to year 4.
That's what?
1070. 1070.
170.
454.
455. Hey, are they coming Zana?
So year 4.
975.
975.
Yeah, this one is fine.
Why are we getting feedback like that?
It's from Divine.
Right.
003.
I think the IRR, like, is able to put it error. So we use the 8% range for it.
8% is yeah, positive. Is that what you are saying?
The 10% we will get positive. What we are using right now, we will get positive at year 4.
Are you sure?
No. What we are using right now won't get positive at year 4.
We won't get positive value.
We will not get positive. We'll get
They
negative.
won't get positive.
So do you give me the year 4 value?
It's 303. The last part is 303.
303.
Yes. Cumulative is negative 95151.
151.
Yes.
Year 5,
Anna.
Year 5
Please,
new.
can I ask a question?
Yeah, question.
Please, the year 4, the accumulated value we got over there, is it not supposed to be the same as the value we got at question I, net present value? Isn't that supposed to be
for which year?
final answer? For the year 4, the last value we've gotten over there, is it not supposed to be the same as for the question I, our net present value? Is it not supposed to be that?
You're talking about this value?
Yes, please.
And I say it should be the same as. Okay. Yeah. It should be the same. Yeah.
That means, so if it's supposed to be the same, that means you made a mistake at the I part with that particular value.
Aye.
Where you just put up to and then came back here. The net present value.
Means that we made a mistake here.
Yes, if it's supposed to be the same, that means you made a mistake here.
But is it always the case that it's supposed to be? I don't know of this, but it looks like
maybe it can be an approximate. It can be an approximate. It's not necessarily like supposed to be the same.
Yeah. No, I mean it will not be the same.
I'm not sure, but I've seen a question.
But I think see the inflows is lesser than the initial outflow. So meaning 15% discount rate. There's no, I would say there's no payback period, right? Because at the end of year 4, there's no cost to pay.
Yeah, so there's no inflow. So someone said that
from the question we had a scrap value of 2,000, right?
2 million.
So I was thinking,
it's 2 million.
Okay, we had a scrap value of 2 million. So I was thinking it's supposed to be added to the last net cash flow. That's year 4. Before we calculate for the net present value.
So it means we add
the scrap value of 2 million to the last year. Not year. At the previous calculation, we were supposed to do that before calculating for the discounting net present value.
So show me which side do you think we add?
Please slow down.
Where we calculated NPV.
Down. And the net cash flow, we are supposed to add it to the last value, that's the 1,705,811.
Yeah.
Yeah, we're supposed to add it there.
So we add 2 million to
1,705,811.
Yeah.
Hey, where's your friend? Like, where did you see this? Well, I'm new to this. Why do you add this?
Who is that? So what? You didn't advance for the 2 million.
Is that we didn't do what?
You didn't calculate the scrap value of 2 million.
We didn't calculate it. I think the guys asked a question on that, and I answered that. So it's actually like that. Now let's complete our. That will be A. What is the A? A is what? A is the number of years. So, 4 years, right? Because after 4 years, if you cannot even pay. So that is the year with the last negative value plus the negative value itself, which is
question
95151. All over the amount from which we need to pay the last negative. Here there is no amount, we can't pay. So what will be the payback period? It will be 4 years. This will go away. It is 0. So we use 4 years, the entire period. Pay. Any question?
The question. Please, the last year, the 4th year.
I don't think
the last year, the 4th year. I want to ask, how did you get the 975,303, the 975,303?
Giving us the feedback.
Hello, sir.
It's
the last year, the 4th year.
The 4th year, okay.
How do you get a 975,303?
Oh, they gave it to me. I think it was in the. That is which of the years? It is in the which one? The discount flows. Is it? Discounted cash flow.
Okay, sir. Thank you.
Welcome. What else? Right, you were on the floor.
Yeah, I don't think we can use this formula and have a conclusion as a 4 years, because if you divide the amount by 0, it's going to be undefined figure. So it's not a 0 amount.
Undefined figure is not 0, right?
Yes.
So undefined figures, what do you do with them?
Yeah. So I think the proper conclusion we can give is the payback period is still the 4 years.
Or we can say that the payback period is cannot be determined because so the payback period is the entire 4 years, because that's the maximum that we have, right? That's the maximum.
Yeah.
It is 4 years and above. The others will need the fire. This one should be like 4 point something, right? 4 point something. But because we cannot pay, the 0 cannot pay, and then you fire, you will choose 4 years. You're 4 years. So, in fact, what the guy said was right. When they are doing the discounted view, we were supposed to get this amount. Look at this amount. We were supposed to get this amount. Right? We were supposed to get this amount as the discounted payback period. Okay. So, why are we getting this? Something didn't go on well. We were supposed to get the NPV. When you are computing for the discount payback period, it should give you, when you are doing a cumulative for the discount payback period, the cumulative final answer should give us the net present value for the payback period, right? But anyway, if you do get to here, there is no time. Yeah.
accounting rate of return then.
Let me know what accounting rate of return. Okay. Someone says you check the what chat room and lecturer said in the terminal year you add the salvage value that action it. You add the what salvage value action, right? Okay. So when you did it with Kingsley, did he add it to the net cash flows? Someone said his question has taken 3 hours and he still can't. Which question is that? Just look at one question.
Actually, this looks like 2 weeks lecture. And we combine 2 weeks lecture.
So, have you solved a similar one in class, Anna? You've not solved a similar one like this in class? Hey.
You've been taught, but there was no salvage value.
Said you've been taught, but there will be what?
There was no salvage value.
The one that you solved, there was no salvage value.
Yeah.
Oh, okay. I'm not really convinced to add salvage value. So, according to the lecture, I said you add the salvage value after taxing it.
If you add it to the cash inflow of the final period.
Oh, okay. So that is the net cash flow. We add 2 million to it.
For the final period.
For the final period. Oh, okay. I go. Thank you. So, according to what's your name? Is that Prince? Is that Prince?
Hello, sir.
Hello.
Please, the C. Why is it 0?
Yes, because we don't have any amount here to make that payment.
Okay, so it's always 0.
It is not always 0 because we are not done paying.
Okay.
So if we have gotten an amount here which would have given us a positive answer, we'd have just paid that amount.
Okay. Thank you.
Yeah, welcome. So Prince, that Prince. It's not Prince. The one said that to add the 2 million after taxing it.
It's not me.
Hey, if you are this, so go and do your research on that, right? Go and do your research on that and give me the feedback. I'll be waiting.
Okay. Simply, the reason why I was saying that is that the payback period questions we're solving, whenever we are giving service value, we add it to the cash inflow.
Exactly. I remember that. We added the normal one that has been solved. Even I think I solved a similar one. We add it. But this one, is it those ones we're also not deducting it from this one? And this one is like we have already added it. Look at the capital allowance. Indirectly, it is embedded in it. What I say. Indirectly, I don't know, but you go and do your research and then give me your findings, right? Do your research. But something like this, do you add the 2 million that has been worked on? Because to me, I would have just left it like that. Now right? You can ask the lecturer if you can. if you are on campus, just get to the lecturer. Or if you have Kingsley's number, you can just call him or text him to find out. Right? And then give me the feedback. Thank you. All right. So what is the next one?
The accounting rate of return.
Yeah. So what is our formula for the accounting rate of return?
The average invest.
Near the point saying, is it for Ivy or the Ivy, right? Accounting rate of return too much. All right. With the one question for the you. This question I thinking all our time. So accounting.
And that's more 4 hours.
Accounting rate of return. Oh, the question will be some questions and then no problem. It's better for you to understand. If you don't get this same, I get a similar one. That would help, right? So when they come, we may carry about 20 marks. Can carry about 20 marks. So you need to understand it and get it once and for all. So what is the formula for the accounting rate of return?
The average annual profit.
Average was
Annual profit
Over the average.
over the average capital invested.
average annual profit over
Yeah,
the
divided by
average what?
Capital outlay.
Average capital outlay.
capital. Okay.
An average investment.
Yeah.
Okay.
Times 100.
Yes. So what is the average annual profit?
So for that one, I think we are going to add all the operating profits and divide it by the years, or
But do we have any profit? How did we get any profit?
I mean, you see, we found the operating profit.
Ever.
In the cash flows.
Operating profit, no. Okay.
After the capital allowance, yeah. After we learn.
Oh, okay. Oh, okay. Okay. So that is the profit. Annual profit. Annual profit. Okay. Then right. So we add them and then we divided by the investment, right? Right. So give me the total for the average annual profit. But even you see, someone even said that we are supposed to get using the cumulative, you are supposed to get the final figure as the NPV that you computed, right? And I've also confirmed that yes, you are supposed to get the final figure. So means that our rounding up didn't help us. So the one thing that we should add the scrap value of 2 million. If you add it to it, are we still going to get the same amount as as the net present value?
No.
You're not going to get that, right?
No, Mr. Philip.
Yeah.
Please, the reason why it's not the same is just because of the first NPV we calculated for. I that one I actually got the 95, I think 151, but then you were like yours is 95149, so that's just the difference. I don't know
Hey,
if you get it.
you had it, right?
Yes, please.
And the one Obi never me figure. So do you think I had that figure? And I'm making like
No, you were also like that's what you accept or something like that.
Someone actually mentioned it, so it's not his fault. Someone actually.
Hey, please you, I beg. 4851 500. Someone give me the figure for the present inflows. So as this, except that there's an error there. So if there's no error here, then it should be yeah.
Yeah, I think is the how we approximate the figures from the beginning. That's why we had the difference is on two. The difference is 2. So it's from the approximation that we did from the beginning.
The difference is just 2. Oh, okay. Then for we see time, I didn't say because it's not the same, though. Who pressure balance, you no, what's on the microphone, sir? Mute yourself if you are not talking. If you are not talking, just mute yourself. Right? And so, please give me the figure for the accounting rate of return. Average annual profit.
It's 1750.
1750. Like this?
312.
312.5. 23. So average, do we divide by number?
Number of average capital outlay.
So so what's the average, and is it not divided by the number?
No. The number I just mentioned to you.
They've done it already.
The number I mentioned to you has already been divided by the 4, the number of years.
Oh, okay. Wow, thank you guys. Good.
Which one has been divided already?
The 1750.
Okay. For the annual profit.
Yes.
So 1750.
313.
313. All of our average investment.
Yes.
What is the average investment?
So a question. So with the average investment, are we dividing the total years by the initial cash flow? That would be the outflow. Or we just do it as with the amount.
Are we having two investments? Investment cost per amount. If you are not having, then I just split this.
All right.
So please, how did you get the average annual profit?
They said they added all the profits and then it divided by 4.
Which one?
Your operating profit.
1, 2, 3, 4.
So that's the net. That's the profit before tax, right?
Yes. The average, does it use profit as
So the average is supposed to be the net cash flow.
Net cash flow for?
If we were to use the profit before tax, we wouldn't divide it by 4. But if we use the net cash flow, we divide it by 4.
Really?
Yeah. From the textbook, you were like, oh.
Go for it, now. Do it now, not down. Okay.
But
So
in the textbook they give in 2 fold though. They have calculating for the accounting rate of return. They have the average investment approach and that of initial investment approach. Right.
So give me the 2 approaches.
So they are all the same, but then one difference is that the other one is the average annual profit divided by the opening value plus the closing value divided by 2. So meaning, I don't know.
Opening value of what?
Opening and closing value, closing asset values.
Yes. So here, do we have any opening and closing?
No.
You just divide by the investment. Except that we have opening. Except that we have opening 2 and divide by 2, right?
Yes. But here it's not like that. That's why it will just be this same formula we will use.
Yeah.
Okay, I'm listening. The one calling.
I'm saying the average annual profits. Why not we use the net cash flow rather?
In the textbook, what did they use?
In the textbook, they gave an example in which they gave them the profit before tax and depreciation was there. So they calculated the depreciation and subtracted it. That's depreciation is also the operating cost, right? They subtracted it and they used the this one net profit after tax. So that's their operating cash flow. Then divided by 4.
After tax, okay. So if it's after tax,
after depreciation, sorry.
Is it after depreciation or after tax?
They gave before tax. They gave before depreciation and calculated depreciation to use the net profit after depreciation. So we're supposed to use the net profit after the operating cost here. That's the tax capital allowance to get our operating cash flow.
Wait. To once, my bro, I property it. To once, because I can bro one by one.
Each challenge. Okay, so I was saying that in the textbook, they gave an example where they gave them the net profits before depreciation.
Profit before depreciation.
Before depreciation. So they calculated the depreciation and subtracted it. Okay. After subtracting before they calculated the average annual profits on that.
Yes.
So my question is, why not we calculate the average annual profit after subtracting the tax and adding the capital allowance? So we use the operating cash flow or
wait. So is it after tax or before tax? Profit is it profit before tax or profit after tax?
It's before tax. So it's before tax. So we use the operating profits for that. But in the textbook,
okay, so I get it.
yes, in the textbook, they use the same as the capital allowance here. So the profit here.
Yes, and then that the capital allowance you are adding it back. So if you use these figures, means you have not even deducted the capital allowance. A year the operating profit.
You have to deduct. The after tax before you calculate the average annual profit.
What I want to know is that is it after tax or before tax?
I get it before tax.
It's before tax in the book.
Yeah.
I want to work with the book. If it's before tax in the book, then what we have done is correct. Right? If it's after tax, we would have to deduct the tax. So, and if it's before
and
tax.
Also,
it is before.
So down.
I'm coming down.
The account rate of return. We are using average investments, but you were using the initial investment. Why?
Yes. So I use the initial investment, average investment. What is the meaning of average investment?
With the average return, so we deduct the square value and divide it by the useful times 100. With the average investment.
So the average investment. What is the average investment? Is it not? Is it the cost
initial
plus
investment?
Is it plus scrap value?
Yeah, minus
yes, please.
Value over the.
It's plus scrap value. The formula is scrap value.
Yes.
Okay, so average investment. Please confirm from the book. What is the formula?
The initial investment minus the scrap value over the useful times 100.
Is it minus or plus?
It's plus.
But let me confirm from my
plus.
Okay, so the accounting rate of return. So the average investment is it plus? Let me see. Average investment. Yes, so it's cost of the investment plus the scrap value.
Plus the scrap value
divided by 2, right? So divided by 2. So so average investment is this plus the scrap value.
Yeah, divided by 2.
Divided by 2. And what are we getting?
Capital added to it.
Exactly. So if there is working capital, we add it. If there is working capital, we add it, right?
Yes, please.
All right. So what are we getting?
The way, so if there is working capital and you add it, so now are you going to divide it by 3 or 2?
No.
It's 2 by 2. Let me see. So it's 2 by 2. It's 2 by 2. So it's 2 by 2. By 2. Okay. So what are we getting?
5,250,000.
5,250,000. Okay. So this is our average investment.
So please, are we ignoring the sunk cost of 500,000?
What are you using?
I thought you said it was also what's the name? Yes, scrap value.
Is sunk cost or scrap value?
Nah.
Okay.
Sunk cost is not the scrap value. So that is 5,250,000. So 5, 2. To do the final figure. Agbena.
That's 3.34%.
33.3%. I think the C part is saying that the C part is saying that discuss the findings in each of the key above and advise that the investment is financially viable. I believe you can do that. So with the NPV, it's a negative. So what do we do? The negative NPV, what do we do? We accept or we reject?
Reject.
We reject the investment, right? Because the negative NPV. With the internal rate of return, what did we say?
It's less, so reject.
Yes, so the IRR is lesser than, because the IRR was lesser than the, so take this, the rule is that with the IRR, the rule is that with the IRR, with the internal rate of return, if the IRR is lesser than the ROCE, return on capital employed, Then you reject the project. And then the sorry?
So meaning you have to find the return on capital employed or investment.
It was already in the question.
Okay.
Look at it. And can you see the target return on capital employed?
Yes.
25%. So I save the project. So what can we say? Since the ROCE is greater than what? The IRR, what do we do? Reject the what? Project. What else? What of the accounting rate of return? How do we analyze it? The discounted payback. Discounted payback is what will you say? What can we see on the discounted payback? It will be paid for what?
Exceed the 3 years. If it exceed the 3 years, and we reject the project.
Exactly. I'm quite sharp. So you see, the target payback is 3 years for the company. The target payback period is what? 3 years. And we are having what? 4 years, right? 4 years and above, a month, right? So if you're having 4 years, that means you have to reject. Because using a discounted payback, we have to reject because the targeted payback period is 3 years, right? And the last one is the accounting rate of return. How do we analyze accounting rate of return?
Accounting rate of return.
Hey, no shark again. Little shark. What is the accounting rate of return? So what is the formula saying? The formula is saying that what? Accounting rate of return. Is in the average what? Average net profit over what? Average investment. Look at the formula.
Is it not also compared to the return on capital employed?
Really? Okay, I'm looking at it from this perspective. Your profit over your cost, over your what? Investment.
So say.
Yeah.
So for the accounting rate of return, is that if the investment is greater than or equal to the rate, then it should be accepted.
The investment, which investment? This investment.
The rate that the rate that we found.
Okay, so what's the rate? What did we get? 33.34%. If it's greater than what?
If it's greater than or equal to the target rate.
So the target rate is what? Is it target return on capital employed?
Yes. So I think there should still be the return on capital employed. I mean, that's our target. Oh.
Exactly. So if it's greater or equal to that, you do what?
You accept. To me, if it's less than that, you also reject.
Reject. Okay. So See, so for the year, do we accept?
Yes, we accept.
We accept the project. Assuming it's less than that, we would have rejected, right?
Yes.
It was I didn't know. I don't know what I said. In the exam room, make many mistakes, right? And you there, don't try to balance it, but try to just enter more what's correct, right? Enter more transactions. And then, but it means if your figures are wrong, your analysis will also be what? Wrong. You get it? If you don't get it.
Sir, please, when are we meeting again?
Ask the bride.
Yeah, the bride is asking.
Hey, the bride, you're asking me this.
No,
The bride.
no.
Bride, you know already. Having an exam to write, and it's around the corner.
It will beat you, the bride.
Pressure. Tonight I have to even do all night because I've used my time to do this. Sorry. So let Dennis take over, right?
Yeah.
Glad Dennis is
Guys, we will meet.
my
Don't
boss.
worry.
This is my boss.